Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management, and we're certainly glad you could join us this week. We know it's another volatile week. The main culprit so far has been the Ukraine-Russia confrontation there, and that's really been ongoing for the last 2 weeks. I think the good news here, more than anything else, is that markets remain above those January 27th lows. Those are important levels as it relates to marking where the correction bottoms and then going through and churning through existing seller inventory as markets try to grind their way upward. We said it over the last 2 weeks. This is not going to be a sexy process. It's going to be a grind. It's going to be up and down and lots of volatility. And it's certainly played out that way so far. Now, in terms of this week, we also had a lot of earnings reports, great numbers out of Airbnb and Trade Desk. On the flip side, we also had some weak numbers from Roblox. Fortunately, we sold most of that position ahead of the report. And then we had Shopify, which we actually like the report. Really good numbers, but obviously the stock getting caught up in sort of this growth sell-off here over the last couple of days. That's something that we remain very bullish on here over the next year, 2 years, 3 years, and beyond. So let's go ahead and get started as it relates to the presentation. Guns, germs, and stocks. That's what we're calling this week's presentation. Why? Well, I think it's pretty obvious. This year, 2022, kind of, 8 weeks in so far, has been marked by war with Ukraine and Russia, or the prospects of war and fear of war between Ukraine and Russia, COVID, the surge, then the decline of COVID cases, and the ensuing volatility in the overall stock market. So what we want to do this week is kind of break the presentation down into 3 pieces. How do geopolitics impact stocks and investments? Should we be worried? Should we be taking action? And what action should we be taking? Number 2, should we be concerned about rising interest rates? How much is priced into the market? Are rising interest rates always bad for stocks? We're going to answer those questions. Lastly, when will inflation begin to ease? We know that it's painful, right? Not just for stocks, but when we go to eat, whether it's at a restaurant, whether we're going to the grocery store, whether we're filling up our gas tank. Inflation is a tax that we experience on a daily basis, and it definitely impacts the psychology of the American consumer. Now, as it relates to geopolitics, the chart here on the right is an important one. Not just on the right, I guess, but all of these charts here are very important. What we've done here is really kind of shown all of the major geopolitical events that have occurred over the last 50 to 60 years. And by the way, this doesn't even include World War II. In World War II, after Pearl Harbor, stocks were up 12 months later. And there's a reason for that. And that pattern has continued throughout all of these geopolitical events. It's because over the long term, geopolitics has no real impact on the fundamental trajectory of the overall stock market. Most businesses are not impacted unless you're in defense or oil and gas or areas that are specifically impacted by that specific war or volatility. When we look at the overall returns, 1 week later, after all of these geopolitical events, stocks are up 0.3%. 1 year later, up 9.3%. Now, it's important. They're not up because of the geopolitical event, and that's our point. You may get a bear market 6 months from now. We're not saying that, but you may, and it will have nothing to do with Ukraine or Russia. You may get a raging bull market. Again, nothing to do with Ukraine or Russia. The long-term fundamentals of the U.S. economy, the U.S. consumer, the input costs of our economy and various businesses that we're invested in, that's what impacts stocks long-term. Day to day, this noise is real garbage. And the fear that we really have here as a team in terms of that daily volatility in the stock market is that people are going to get shaken out here, not just with our strategies, but just across the stock market as a whole, right as things are beginning to recover. So we want to be really, really careful while not taking geopolitics too seriously as it relates to investments. Now, in terms of overall investor sentiment, this is a huge asset for us right now, believe it or not. When the market is bearish, we don't know if the markets turn up a week from now or 2 weeks from now or a day from now. But 1 year from now, 6 months from now, there is historically a very bullish trend when people are very bearish. So the further to the left you are on this chart is the more bearish you are, right? So overly pessimistic by different deciles. When you're in the second to third decile of being the most pessimistic, you get some of the best 6 to 12 month forward returns in the stock market. And where we are right now is in this third decile. We were in the second decile, market bottoms. We've migrated to the third decile, which is the second most attractive time that you want to be invested in the market. Now, remember, we were at 2 just a few weeks ago on that January 27th bottom. So this is an attractive time for when we see everyone's negative, everyone's scared, we want to lean in and we want to be buyers of our favorite long-term stocks. Now, Tuesday was an interesting day. Now, I'm not cherry picking on Tuesday because it was up, but when we do get those up days, we want to see, as we're coming out of a market correction like we are right now, are things behaving the way we want it to as it relates to the portfolio and as it relates to the broader market? And what do I mean by that? The stuff that's at the center of the storm, those are the things you want to see leading the charge out of the gutter, basically. So stocks furthest from the 52-week high on Tuesday were up 4.3%. Stocks that were closest to their 52-week high, in other words, stocks that were near a high point, were only up 0.7%. And the good news is that advancing stocks as a percentage of the total market were exceeded 90%. That's what we call a positive breadth thrust. We want that to happen on these washout days, right? So following intense selling, we get this upside surprise. Are we getting most stocks that are participating in that rally? So we've had lagging stocks outperform leading stocks on those up days. First check mark. Number 2, high breadth on buying. Check mark number 2. The one thing that is lacking right now are multiple follow-through days. That is very typical after you get the first bottom before you retest, which is what we're doing right now. And as it relates to interest rates, when we look at the 2-year interest rate, it's trading around 1.5% versus Fed funds policy is still in 0 to 0.25%. Why is that important? The 2-year is used as a proxy for what the market is pricing in as Fed funds policy in the future. So the 2-year gets there faster than the Fed does. Now at 1.5%, guess what? It's almost like we've already had 6 interest rate increases. So if the Fed increases 50 basis points in March, guess what? The market's already raised it 1.5% by pushing the 2-year to 1.5%. Take a look at mortgage rates, which are more priced off the 10-year, but they've gone up almost 1.5 points over the last 6 to 8 weeks. Lending instruments are repricing. Liquidity is repricing. And that's good news because it's already priced into stocks. So you want to buy the stocks in the sectors that have gotten hit the most on the fear of interest rate increases. Why? Because it's already taking place. And guess what? They're still doing great. We're seeing it in those earnings reports. And then lastly is inflation peaking, right? So we want to look at consumer prices. We know they're hurting right now, but we want to look at rate of change. Is it getting less bad or is it getting worse in terms of that intensity? And what we see is despite sort of sketchy reports from CPI and PPI over the last week, they're still less bad than they were back in 2021, late 2021. Same thing with inflation expectations. We're seeing the expectations of future inflation come in quite dramatically, and that tends to be a pretty reliable leading indicator for the overall inflation rate. Now, as it relates to investor psychology and what they're actually doing with their money, they're selling, and they're selling really hard, and you're seeing it on days like today on Thursday. When you get record selling of futures contracts, that has historically tended to be a very bullish signal for future returns. Heavy selling, that is what we call capitulation. And then lastly, of course, is the rush for safety. Remember, puts pay off when stocks go down in price. The net put value traded as a percentage of overall market cap hit a record high over the last week. This is bullish. This only happened 2 other times. March of 2020, remember we had that initial low, a couple of good days, and a second fearful selling, then finally off to the races. Same thing with the US debt downgrade. big sell-off in August, a little bit of a rally, a retest before we are off on to the races. So overall, geopolitics is really scary. You see these scary headlines with Russia confronting the US, and you must wonder, well, oh my God, we're going to have a war with Russia. That's very bearish for stocks. But neither country wants war with each other. Neither country wants to get in a confrontation of great powers. And guess what? If it does happen, no one's going to be worried about their brokerage account. But the 99.9999% likely outcome is that there is a resolution to this. Stocks move on the same way they did in 2014 when Russia seized Crimea and moved troops into the Donbass. That was a scary time too, but guess what? 2 weeks later, the market moved on and the bull market resumed. So we want to be disciplined around this. There's a lot of things that keep me awake at night. Geopolitics is not one of them as it relates to stocks. And then lastly, of course, inflation does appear that it continues to grab headlines, but the intensity of that is rolling over, while overall interest rate increases have been largely priced in by the bond market. So we do want to focus on those areas of the market that have been most punished by the recent sell-off. So again, thank you for all your patience. We know the volatility has been crazy up and down. We're still off those January 27th lows. That's a good signal. So we want to continue that. We want to continue that pattern. We want volatility to come down over time, but we do want that upside volatility on the recovery. So if anyone have any questions or concerns, please feel free to reach out with your local advisor, or feel free to reach out at our office at 888-543-3776. Thank you again and have a fantastic weekend.